Okay, good morning, everyone. So we're covering chapter 4 today, and let me see if we have too many people on the Zoom call right now. But we're going to talk about some more into chapter 4. Chapter 4 deals with the income statement and primarily, but we also get into comprehensive income, which is sort of a sort of a collateral piece to this, and also we'll get to the statement of cash flows probably today. And then on Thursday, my goal is to sort of wrap this up and talk a bit about the exam, which is coming up. So anyway, so here's a brief look at the syllabus, and I deferred the activities from chapters 2 through 4, and I know I've said this a number of times. So the due date for this particular chapter's activities are going to be this week, and so keep in mind we have an exam, and it's chapters 1 through 4. The exam should be available now. If you try to, I don't know if anyone's trying to take it yet, but it is available if you're wanting to take it, and it's available for you. So, all right. So, what I want to do is pick up from where we left off last time, talking about the income statement, particularly earnings per share. So, I think we kind of made our way through most of the income statement and talked a bit about the elements of that. We sort of drilled down a little bit deeper than what we did in Principles 1, where we basically talked about what we call the three-step income statement. That is that leading sort of going downwards to cost of goods sold and gross profit, operating income, and then net income. Here we're going to sort of drill down a little bit deeper, particularly in talking about earnings per share. And earnings per share, as I think I mentioned a little bit on the last video, is sort of misleading unless you are putting it in context. And I think that's really the key issue, is putting the whole thing in context. And it's this idea that a company earns income, but what does it mean to the individual shareholder? And but nonetheless, even if you know what the individual shareholder has, you still have to know, what the share price is at the moment, and in order to be able to compare that to make a good comparison. So, because a lot of companies will report on a quarterly basis, we earn 67 cents a share. What the heck does that mean? It means really nothing unless you sort of put it in context with the current share price. And then even then, it really relates to what your original cost is to determine whether or not this company is meeting your expectations as an investor. So when we talk about EPS, we're talking about really two different measures. One is what's called basic, and that's the most obvious one. And that's simply the idea of net income minus preferred stock dividends. The stock dividends are taken out on preferred shares if you want. And one of the things that sort of the theme of accounting, financial accounting generally, is you can take all the information that's given to you by a public company and slice and dice it however you want. And if you want to include preferred shares or not, it's up to you. In this particular academic example, we're taking preferred stock dividends out. So we have a net income figure minus dividends over the weighted average number of shares outstanding. We talk about weighted average, we're basically talking about the fact that share counts throughout the year may differ. And so we're going to weight those based upon time and how many shares were outstanding over the period of time. And so we're going to get into with a dollar figure. Earnings per share is a dollar figure. Okay. So this particular example, we have 600,000 in net income. And this is an after-tax figure, minus the preferred dividends. You have 525 in the numerator, and we have the weighted average number of shares. Looks like there are 1 million shares outstanding, plus another 1 million shares that were issued sometime, maybe April 1st, so to speak. And so you have 1,750,000 on average throughout the year. So 30 cents per share, earnings per share. Okay? And that's the basic idea of how we would compute earnings per share. And that's what we call the basic earnings per share. Diluted, though, is a little bit different, because what are we talking about when we talk about dilution? Dilution is a common topic everywhere, pretty much, in finance, and that's the idea that sometimes companies will issue new shares of stock, and by doing that, they will water down the percentage ownership in individual shares as a result. So the dilutive effect of all potential shares. Now, what do I mean by potential shares? There are really a couple different alternatives here as to what we mean. Number one, these could be conversions, that is from preferred stock to common. There is a class of preferred stock. It's called convertibles, and it's not always the case with every company, but Sometimes companies will have a preferred issue. And preferred stock, in my mind, I've always thought about preferred stock as being almost more like a debt security than equity, even though there are a lot of benefits of preferred stock, particularly in taxation of dividends, which is at a more favorable dividend tax rate. But really, preferred stock is sort of a hybrid class of stock that can be converted to common. And as a result of that, if people convert preferred to common, that would water down the shares of common stock. And so as a result, would dilute the earnings per share simply because the denominator is going up. More likely, though, it's probably the exercise of stock options as a part of employees' compensation. Increasingly in the last, several decades, companies are rewarding people, particularly management, but increasingly throughout the company, with stock options that allow employees to exercise their rights to buy stock at a certain price. Usually, you wouldn't do it unless the stock price is or the strike price is lower than the market price. But and so and we can get into options, and it's a rather complex issue. But nonetheless, that's an issue that is out there. It's a part of employee compensation. There are also other things like restricted stock units that are awarded to employees at times, and so these are all potential areas in which what we call the float, that is the number of shares outstanding, can actually go up with the issuance of new shares for whatever particular reason, either whether it's a conversion or whether it's due to people exercising options or whatnot. Okay. All right. So that's what earnings per share is. There's an example here that we'll talk about, which gets into this. And so this is the Abbott Labs example. And so at the bottom of their income statement, they're breaking out earnings per share at a basic level, 94 cents a share in 2016. And earnings per share diluted is also 94 cents per share. And so there's not much change there. And often there would not be a change unless there are shares outstanding. Sometimes also there are shares that are issued to top executives after an initial public offering, and they're sort of locked out of exercising those shares and selling them and putting them on the market and whatnot. So those are restricted. That's restricted stock, and so there are a lot of issues that may impact this particular measure. So a quick quiz, concept check: which of the following represents a change in accounting principle? Now let me kind of go back here, because this is sort of where we left off last time, where we talked about why would there be differences in measurement, and some of it could be due to things like change in accounting principle, things like changes in estimates, things like change in the reporting entity itself. So change in accounting principle is this idea that we're applying a different principle to the same activity that we were before for whatever reason. The example given in the text was changing from a FIFO to LIFO, or LIFO to average cost, or whatever it is. And so which of the following represents a change in accounting principle? Number one, A, using a journal entry to correct a misstatement. B, changing inventory from LIFO to average cost. C, modifying the amount of bad debt expense. D, correcting material error. Well, the one that I sort of kind of led you to water here was this idea of B, changing inventory method from LIFO to average cost, because, and the text indicates C is a change in estimate. If we think our bad debt is going to increase or decrease in the coming year, that's not really a change in principle. It's just simply a change in estimate. And the same could be true with things like changes in depreciation, where we're altering and adjusting, I should say, sort of midstream, mid-life of a long-term asset, where we think it's going to last 10 years. We now only think it's going to last 7 years. So therefore, we're going to adjust the estimated useful life of that. Or maybe the residual value, the salvage value, is going to change. That's an issue. But those are changes in estimates, right? And also we talked about the issue of errors, and errors are a completely different issue altogether. If there's an error, well, it's an error, and so it has to be fixed. And so somebody's going to go back, and if it's material, there'll be a restatement of the financial statements. If it's not material, it'll sort of be noted in going forward. And there are some rules that FASB has, some guidelines as to what amount of threshold you can absorb without restating financial statements. As I indicated last time, companies really, really do not want to restate financial statements, go back, in other words, and recreate history. And the reason is very simple, because it's, the financial community reacts pretty negatively to that. And there are a lot of questions about, does this company actually know what the heck they're doing? So that's kind of what is going on there. Okay. All right. Let's talk about comprehensive income. This is an area that is, um, it's sort of an area that wasn't really covered all that much, back in my day, but it's become a more important topic. And it's the idea, the comprehensive income basically is this idea of capturing all income that is flowing into the company, whether it's due to normal operations or whether it's due to something else. Okay. And so when we talk about transaction with owners, and this is something we talked, the text gets into quite a lot of it about the idea of transaction with owners, transaction with non-owners, and non-owners typically being lenders and other parties. But all changes in equity during a period arise from non-owner sources and represent comprehensive income. Comprehensive income is net income, which is the net income that we know about. That's all after all operating expenses, non-operating expenses, whatever. And then you have this other area called other comprehensive income. And there are a few things that go into it. And we talk about OCI, or other comprehensive income. It's an income statement item that may be included on the income statement, or potentially included. There are a couple different ways to report this on a separate statement, which follows immediately after the income statement in the financial reporting. And they include things like net unrealized holding gains and losses on investments. This has become a bigger issue in the sense that a lot of companies hold securities. They go up and down in value, and so as a result, these unrealized holding gains and losses are included in that. When we say unrealized, it means that we're still holding those, we, the company, in other words. And so we can't really report these as an actual income statement item, but we're going to report these as an element of what's going on. Gains or losses from post-retirement benefit plans. This issue of pension valuation accounting, it's a pretty complex area. It's sort of a specialized area. People will spend their entire careers dealing with pension accounting and whatnot. We're not going to get into this too much. In intermediate 2, I do think we get more into that than what we do here. Deferred gains or losses from derivatives. Derivatives are simply financial instruments that allow companies to do a lot of different things, particularly, as we noted in the Apple example, hedging transactions, where a company will take a position that sort of offsets its main projected position in order to sort of mitigate the loss, the downside loss and whatnot. Derivatives, this is not a finance course, and so we could talk a lot about derivatives, whether we're talking about options or forward contracts or futures contracts. All these are elements that are related to derivatives. And the reason it's called a derivative is because it's the value is based on some underlying asset of value, and whatever that is. Okay. And again, this is a broad topic, and it's something that we could talk more about. For those of you who are going to be finance majors, you'll talk more about it. And the foreign currency translation adjustment, this is really a big one. In fact, there was an accounting standards update in ASU that came out in the last year or so from FASB, talking about the fact that companies really need to disclose better what these currency issues are between an American publicly traded company, which may not be American, but it trades in America, versus other currencies, and requiring them to sort of break out all these individual changes in valuation simply due to the fact that currencies themselves are commodities. They trade in the open market, they go up and down, and so as a result, people gain and lose simply because of changes in currency values. And what we call CTA, the currency translation adjustment, is one of the big ones that goes in the comprehensive income. So comprehensive income really is inclusive of not just net income from the day-to-day operations, and even not the day-to-day operations, there's gains and losses from things. So we have a building you sell and a gain, that's not operating income, but it's nonetheless part of net income. But it's not part of this issue of what we call OCI, right? These are things that are sort of tangential to business, but nonetheless have to be reported because they do affect shareholders' equity. And that's really what we're sort of getting back to, is this idea, and it's a theme that we've been talking about for a long time, is the idea that the income statement and the balance sheet sort of articulate together, and they work together. So changes in OCI in a positive sense will raise shareholders' equity, in a negative sense will decline, will cause a decrease in shareholders' equity. So now these two issues sort of work together. So, and we talked about reporting here. Again, the slide package is in in your text as well as the Brightspace site. So it can be done as two different ways. One is a single continuous statement of comprehensive income, where you end up with a bottom line being comprehensive income. Okay. What I think is probably more desirable on the part of a lot of reporting firms is this idea of two separate but consecutive statements. And I showed you the illustration of Apple, and we'll get into other examples of public companies. I'm not just focusing on one or the other, but two separate statements. Where one, we have an income statement that ends at net income. So we have bottom line net income, which is usually on an after-tax basis, and then an adjoining statement of comprehensive income, which takes into account those key elements which fit into comprehensive income and what they are. And things like, and again, the two big ones, in my mind, I think, at least in my experience, are these pension valuation adjustments, to the extent that a lot of companies still have pension assets out there, and also currency issues. Most of the public companies that we see doing business today are multinational and deal across international lines and deal with things like pesos, euros, yen, and whatnot. So as a result, we're going to have these changes in valuation, which have nothing to do with operating expertise or whatever, right? They simply are the fact that currencies are commodities, they trade in the open market, and as a result, there are going to be some changes in earnings as a result of these. And so that's simply the way things work. And until we have one single currency, which I don't be that happening anytime soon, we're going to have these kind of things. So, all right, so let's take a look at these ideas as a separate statement. So we have net income. These are obviously little X's here. They're not actual figures. And Astronova is the example given here. And you have a consolidated statement of comprehensive income, which really has net income, and then these other issues here. And so as a result, you have other comprehensive income is negative 81,000 in this case. And so as a result, that's the number that we end up with. It will translate to the balance sheet ultimately, but we'll get to that in a second. So OCI is reported on a cumulative basis in the balance sheet. So remember, we're talking here about Chapter 4 really deals with the income statement. But what's interesting about this discussion is, yes, it talks about the income statement, but it also has relevance to the balance sheet because things roll over to that. So OCI, which is an annual reporting issue that is on the income statement or is not on the income statement, nonetheless feeds into what we call feeds into what we call AOCI, accumulated other comprehensive income, which goes into shareholders' equity on the balance sheet. And remember, this articulation between the income statement and balance sheet is a common theme, really, of intermediate accounting or financial accounting generally. This idea that if one thing changes in the income statement, it's probably going to affect shareholders' equity. And by the way, this is really sort of the logic of what we do in Principles 1, is we talk about this idea of something changes on the income statement, it immediately changes something on the balance sheet. And this idea of affecting the accounting equation of assets equals liabilities plus shareholders' equity is really an important way to sort of view what we're doing here. Okay. All right, so let's talk about shareholders' equity here and the effect of this. So accumulated other comprehensive income is a figure. In this case, it's negative. In the case of Astronova, although I think the numbers don't quite jive here, but nonetheless, we get the idea that we have net income, right? So if we take a look at what's going on here, we have the balance of retained earnings is at 131 in 2016 is 42 million, it looks like. And we add net income. And so as a result, we also deduct dividends. And so we as a result, we have a balance at 131 of 2017, which would appear to be the year end. Well, it is the year end, right? As of January 31st of 2017. But we also have accumulated other comprehensive income of negative 975,000 in this case. And in other comprehensive income is 1,000. So this is what was in the balance right here. Okay, this is what existed prior to this beginning of this particular fiscal year that began in 2016, ends in 2017. We had a negative $975,000 balance in accumulated other comprehensive income. What is that? What's the accumulation over time of all these elements that go into OCI in the first place? Whatever it is, currency translation, pension valuation, whatever the case might be. And as a result, we we ended up more negative this year. And so as a result, we have $1 million. That's a negative value to accumulate other comprehensive income. In other words, it reduces shareholders' equity by that amount. And this is an important element, and we see it all the time in financial statements. This idea that we get either positive or negative, whatever the case might be, but it's an addition or subtraction to shareholders' equity, even though it's not really part of the operating results. It's not, and you can argue or not argue whether or not management is responsible for good or bad results here. They are nonetheless sort of tangential. And we'll get to the idea of where the international standards sort of align. They're pretty similar to what we do here in the US. We can't say that about every particular element of reporting, but we can in this particular case. And so what's the relationship here between net income and other comprehensive income, right? So in this case, we have a $10 million net of tax gain. Now, by the way, we're going to view this in a couple different aspects, and we're going to sort of determine whether or not one is better than the other. Or we won't. I mean, we'll decide for ourselves, what the relative merits of these different approaches are. So in this case, we have the first alternative. We have a $10 million net of tax gain. Obviously, we'll have to take, and it's after tax. And so as a result, here, this is the balance sheet figures. I'm trying to find my cursor here. And we have retained earnings of $700 million. We had net income of $10 million. And the gain adds to accumulated retained earnings, right? And we have dividends, and dividends are discretionary to the company itself. Accumulated other comprehensive income was $30 million. So as a result, we add this 30 to the 770 in retained earnings. Remember, retained earnings is this important element of accumulated earnings that have never been distributed back to shareholders, have been taxed away. It's simply an accumulation of earnings, and we call it capitalization of earnings. And it's meant on the asset side by whatever it is, equipment, inventory, whatever the case might be. So in this case, we end up $800 million, okay? Under the other approach here, where we have 10 million, and if it's reported as part of other comprehensive income, then it goes to a different place. We put it over here, right? Both are going to get you the same figure. They're going to get you to the same place. So whichever the approach is to recording this amount of income will result in ultimately the same effect on shareholders' equity. And we see this a lot in accounting, where we have different approaches to get to the same thing, but it really is reflective of, sort of management's philosophy, how accountants want to treat things. Not so much what the regulations are, because companies are going to report what in a way that they have to report based upon the GAAP standards. But in this case, we have two different ways of looking at it. One was putting it into net income. The other was putting it as a separate item, right? One was net income, one was a separate item. So as a result, here at net income, we simply put that, whatever that 10 million, we don't even know what it was. I mean, it doesn't really matter. But here we're putting it into earnings, and it just gives us the retained earnings. Here we're going to simply book it into other accumulated comprehensive income. Why? Because we took it out of comprehensive income in the first place, and so it lands over here. The same effect is going on here, just a different way of reporting. And we see this from time to time in financial accounting, where we have different methods for reporting things, and we get to the same place, but there are different preferences for how we sort of do this reporting. And do we do it one way, or do we do it the other? This is why financial analysts will sort of slice and dice and pick apart financial statements to find out what companies are doing and why they're doing it. And in most cases, it argues for consistency, because it makes it easier to sort of view what's happening. Okay. All right. So any questions about any of this so far? Okay. Well, let's do a bit of a brief comparison here between the international standards and GAAP. They're not big, really. They're not. And we talked about this a bit in intermediate accounting. We're always sort of comparing GAAP to IFRS standards, and so in the U.S. GAAP rules, companies are allowed to report comprehensive income in either a single statement or in two separate but consecutive statements. The example we showed in class of Apple was two consecutive statements, but they both fold together, and they ultimately have the same effect on shareholders' equity as they reconcile to AOCI. in the IFR standard, same as under US GAAP. However, and this is a big one here, it changes in revaluation surplus. And so this is where, and I said this in the very first class session, when we talk about the differences between GAAP and international standards, I think one of the big ones is this idea of asset valuation. This idea that in the international standards, we can potentially step up the value of an asset. And we're talking about particularly long-term assets, tangible or intangible, either one, where we're saying, okay, the fair value has risen, so as a result, we're going to step this up. And as a result of stepping up that value, we're going to include this under OCI, that is an increase in income as a result of the fact that this asset has risen, okay, in value. And we're talking about particularly liquid assets, but not just liquid assets. And keep in mind too, I don't want to muddy the waters too much here because we can spend weeks talking about this, but there are some assets that are difficult to value, and we certainly saw this during the financial crisis where we had these really extreme derivative instruments that nobody really ever heard of, and like credit default swaps, and which I had never heard of before, but by the way, neither had the Fed Chairman Ben Bernanke, and so it had to sort of be explained what was going on. But there was no real good value measure of those particular things, and so but that's sort of a sidetrack here. When we talk about valuation, and the differences between international and the GAAP standards is that we can step up the value. Okay. Now, I will say this: there are passionate adherents to the idea of historical cost on the GAAP side of the ledger here, and that's the idea that we know what the value is because at some point somebody paid this for it. Now, this ignores the fact that maybe they were paid for it back in 1930 or whatever, but nonetheless, an arm's length transaction is a pretty good measure of what the value is worth. So I do think there's a lot of value in international standards in this regard, but there are very passionate believers, particularly in the academic accounting community, about historical cost and the idea that we should not step up the value of assets for market value changes. And by the way, and the argument there is, how do we know what the market value changes? How, according to whom? And is this price stable? Is it volatile? Whatever. So you kind of get the idea. This is a long-running argument. It's one we're not going to resolve here, but it's one that's worth noting. It's worth talking about. Okay. All right. Quick quiz. Other comprehensive income. Which of the following is not an example of comprehensive income from sales, unrealized loss on securities available for sale, foreign currency translation adjustments, deferred gains from derivatives? Well, the answer is A, income from sales. Income from sales is simply part of operating activities, and it's not it's part of net income, but it's not really an example of other comprehensive income. The last three here are this unrealized loss on securities. And that is the idea that the securities can lose value, and so as a result, we would mark the value down. And by the way, this was one of the causal factors behind some of the bank failures of, I think it was 2023, where we had a number of banks that sort of went under because they had bond holdings that were declining rapidly in value, and they had to report them as an income statement item, and it actually brought the income of the firm down. And so it was a big deal where the companies, these banking companies, lost money on paper, really, frankly, and depositors wanted their money back and all that good stuff. And so you get the idea. So these were unrealized losses. We talked about foreign currency and deferred gains from derivatives, or losses for that matter, could be an element of comprehensive income. And companies and by the way, we talk about this idea of derivatives. I know that sometimes the press will talk about derivatives as being these crazy, wild, speculative items and whatnot, but they've been around for a very long time. In fact, the term derivatives is sort of a catch-all category that includes things like futures trading and things like commodities futures, which is a market that I've never ever heard been subject to manipulation or problems or whatnot. My grandfather was a farmer. He would lock in prices of grains and beef and pork and whatnot many months ahead of time, and it's just simply a way to manage risk, and usually there's no real issue about it. So and some of these markets are very orderly and have never really had the kind of trouble that we saw, particularly leading up to the financial crisis, which really was not so much based on derivatives, it was more based upon just sort of bad lending at the end of the day. Okay. All right. So questions about this particular quiz here. Okay, so we're about, let's see, it's about 11 o'clock. We've got about 45 minutes, and I want to get into the statement of cash flows. This is sort of a change. Remember, this particular chapter deals with primarily the two other statements we did not talk about. Chapter 3 dealt with the balance sheet. We sort of drilled down into the balance sheet. We also got into the income statement here earlier, and now we're going to get to the statement of cash flows. This is something that if you took Principles 1 here, we didn't really get into, and I've talked about that before. It really belongs more in intermediate accounting, and because it's an important statement, but it's also it's a little bit trickier as opposed to things like the balance sheet and income statement. So what is the statement of cash flow? It's going to mirror the period of the income statement itself. So remember, and I think I mentioned this in one of the discussion posts, is of the four main statements that are reported by public companies, balance sheet, income statement, statement of retained earnings, statement of cash flows. The one that is not a one period to a period beginning to period ending is the balance sheet. All these others sort of flow along with the income statement based on whatever the fiscal year of the company is. And a fiscal year is not always the calendar year. It's in fact not often the calendar year. It could be February 3rd to February 2nd of the next year, right? Who knows what it is, for all kinds of different reasons, but it will mirror the reporting period of the income statement itself. And so it's going to be required whenever we produce a balance sheet and income statement. Now, I know that in smaller businesses, and I know that when I was a commercial lender dealing initially before I sort of moved up a little bit higher in the big leagues, a lot of accountants would say, do you want a cash flow statement? And we would say no, because we really just wanted the balance sheet and income statement. But the statement of cash flows is important because it does report on what the heck is going on with the cash of the company itself. Okay, and I'm not a forensic accountant, but I do think that forensic accountants. I did study under one in my doctoral program so the statement of cash flows was this beginning point for sort of investigating where the cash is coming from and where it's going and whatnot. So we talk about the money in, money out is really what's going on, receipts and disbursements. And so in cash itself, let's just sort of talk about what's going on here. Cash, by the way, this is the very first line item on the asset side of the balance sheet. And it's usually not cash, but it's cash and equivalents. And cash equivalents are those things which are easily convertible back to cash. Things like treasury bills, money market funds, things like that, things which can be easily converted to cash, and so they might as well be cash because they sort of are. And then also things like restricted cash. Restricted cash are when a company sort of segregates cash for a particular purpose, whatever that may be, whether it's to settle a lawsuit, to retire bond debt, whatever the case might be. But nonetheless, cash includes all these. And so the three categories, this is the big one here, is OIF, operating, investing, and financing activities. And so the cash flow statement itself is going to be divided by these three different activities. And by the way, this is something we talked a bit about, even though we didn't really drill down into the cash flow statement in Principles 1. We did talk about the fact that what are the three main activities? If we can sort of deconstruct what management activities are throughout a period, we're saying they're operating activities, which obviously takes up a lot of time in the sense this is the day-to-day stuff of making things, selling them, collecting things, paying for things, all these kind of things. Those are operating activities. Investing, which really has more to do with sort of the left side of the balance sheet, investing in things like equipment, paying off equipment, or getting rid of equipment and whatnot. And then the financing activities, which are more the right side of the balance sheet. How are we financing these activities on the left side? So this is more of an income statement concept here, operating activities. This is more of a left side balance sheet. This is more of a right side balance sheet. But they all kind of work together, but that's sort of the general focus here. And we're going to talk about all these operating, investing, and financing, and where the money comes from and how we account for it. And there are really two main methods by which we do the accounting for cash flow. And by the way, let me just say one thing about cash flow. It's probably one of the least understood terms in business and finance and accounting and whatnot, because we think of cash flow. I think probably most people. Let me just tell you my opinion, and whether it's bonkers or not is sort of up to you. But I think most people view cash flow as being a short-term issue where it's a liquidity issue. It's a solvency. I'm sorry, it's a liquidity issue where maybe I don't have enough cash to pay my rent or electricity or whatever, and so in other words, there's a cash flow problem. In other words, it's a very short-term sort of issue. It's more dealing with liquidity. Right? Most people would probably believe that cash flow deals with that. However, in the statement of cash flow, we're also talking about solvency, which is a longer-term issue, dealing with can I generate enough cash to cover debt and to satisfy the obligations or the expectations of shareholders over a very long time period. So it's really both. It's not just one. It's not just liquidity. It's also solvency as well. And we talked a bit about this when we talked about financial ratios and those categories. And we said liquidity is based upon these very short-term needs for cash in order to do things like make payables and all those kind of things, salaries, wages, all that. Solvency is more dealing with things like long-term debt and also all other kind of obligations that the company's dealing with. Okay, so investing more of the left side balance sheet, that is assets, financing more dealing with debt and equity. And it's not just debt, it's also equity in the sense that companies can be funded by one or two ways, debt or equity. We're going to sort of get to that and talk more about what those are about. So let's get into the statement of cash flows here. And I keep losing my cursor. I think there we go. All right. So a quick question here. Which of the following is true concerning the statement of cash flows? A, statement of cash flows can provide information helpful in assessing future profitability, liquidity, and solvency. Okay. B, the statement of cash flow shows cash receipts and cash disbursement. Sounds good. Statement of cash flows is required to be presented for any period for which an income statement is presented. Remember, it matches the income statement time period. All the answers are true. So the answer is D to that. Okay. All right. So let's get to operating activities. This is the one is probably the one that is the trickiest, and it's one that we have to include lots and lots of money in, money out, and whatnot. And there are different ways to sort of report this, but we're talking about inflows and outflows of cash, which we're going to reconcile with the beginning cash at the beginning of the accounting period, whatever it is. Let's just assume it's January the 1st and we end at December 31st. We're going to assume that we can take the cash at January the 1st and reconcile it with the cash at the end of the statement period, December 31st, by taking into account all the cash inflows for all the activities that we're doing, sales of goods and services, probably the biggest, I would presume, right? Interest and dividends from investments, it's money in. And we'll talk about this issue of should it be an operating or other activity a bit later. Cash outflows, buying inventory, paying wages, all these other sorts of things. And we end up with a net cash flow from operating activities, okay? And it's the difference, whatever it is, positive or negative, right? And by the way, a negative difference here isn't necessarily bad. Maybe a company doesn't want to have as much cash on hand as what they did before. Remember, when we talked about the current ratio earlier, we said that a lot of companies are running very, very thin on cash because cash itself doesn't really do much for the company, right? Instead, maybe they want to invest in other kind of things which are more profitable long term. And there are a lot of ways that public companies, particularly very profitable ones, can raise cash in the very short term. So, running low on cash is not really the death sentence that you might think it is necessarily. Okay, so it can be positive or negative. We're not going to make a judgment as to whether or not this is good or bad. Remember, in the discussion of financial ratios, I said, in general, higher the better, lower the better, whatever the case might be. I don't know that you can make that judgment here because it really is very much case specific as to what's going on. And by the way, this is only one of the three elements of the cash flow statement. Okay. All right. So any questions about what's going on with the operating statement? I don't think we have anybody on a Zoom call live today. So, okay. So we have two different methods of reporting this, and one's called the direct method, and the other is called the indirect method. The direct method basically says every operating activity is reported and into the statement itself, and so you're actually breaking out exactly what is going on because we've traced the changes in the cash flow statement back to what the changes in cash were, and so reporting is a direct method. Okay. The indirect method, which is the most commonly used, is where we simply back into this. And this is frankly the way that accountants typically do it. I know FASB sort of prefers the direct method, but it's challenging. It's not really. And by the way, you're going to get to the same, hopefully get the same facts at the end of the day. Direct and indirect method are going to get there. But how we do this is simply take net cash flow by taking net income and then working backwards by converting it to a cash basis. Now, this sounds, it's like, okay, that's great. All you've done is read the slide. So what does it mean? Well, what it means is we're going to simply take some rules here and we're going to apply them, and we're going to end up with a net operating cash flow, positive or negative, from operating activities, whatever the case might be, right? And by the way, I should probably pull this up. I didn't think about this ahead of time, but your text has got a couple of really good diagrams here that I think are worth looking at. And I'm going to sort of pull these up if I can and go to those here in the text. And they're going to be on, let me see here, on page 90, I think is ultimately where we're going for. So, all right, so I should have pulled this up. I didn't think to do it. My apologies for that. So let me do that here real quickly. But I think these are really good illustrations. And by the way, did not make its way to the sort of slide package here. And so that's something we should maybe take issue with. So all right. So we get to, this is comprehensive income here. So all right. Let me come back to that. Well, I will come back to this because this does illustrate a lot of things that I do want to sort of talk about here. So let's go to, actually, let's do this right now. Page 93. I had the wrong page, actually. So let's go. Okay. So let's think about what's going on. So let's take operating cash flows first of all. Okay. And when we talk about what's going on here, let's look at, this is illustration 414, page 93 in the text, which I think is something you ought to sort of, write down and sort of memorize. This is the idea of, remember, we're trying to get to operating, investing, and financing activities. These are the inflows, all these things that are going on, collecting interest, providing services, collecting dividends from our investments, but also these things which are outflows here, okay? And these are elements that we want to sort of account for as we sort of back our way into ending cash at the end of the accounting period, right? And so I would sort of urge everybody to sort of, take a look at this and sort of, dog ear it, whatever you want to do, so that you know what's going on, right? So we're going to talk about the indirect versus indirect method. So let's talk about the contrast. So first of all, we're going to talk. First of all, we have an income statement here. Arlington Lawn Care. It's a hypothetical company. We have net income of 45, I guess, thousand or whatever. It doesn't say, but so we have a net income here, okay, and then we have a balance sheet right below it, okay. Nothing terribly exciting here, other than the fact that we're going to be sort of building on this. So if we want the direct method, which I underline direct, representing cash flows from operating activities, what are we doing? Well, we're going to take the cash flows from operating activities, such as the cash received by customers, from customers, the cash paid for general administrative expenses, the cash paid for income taxes, and so we end up with a net cash flow from operating activities, which we ought to be able to reconcile again back to the income statement. Again, these statements fold back into one another, right? So this is year-end December 31st of 2021, okay? And that's using the direct method, where we're sort of going into these elements here of saying, okay, these are all these kind of things. We're going to capture all these, right? And this is what we're going to include here, and we're going to end up with an ending balance in cash from that particular activity. And we'll get to investing and financing here in a second, but that's essentially what's going on there, okay? If we talk about the indirect method, all right, the indirect method basically says this, and this is, it seems like it's a little bit deceptive, but it's not really, because it really reflects the idea that certain things are increasing or decreasing and do not affect cash whatsoever. So we're going to start with the same income, and again, here we break it down thousands. It didn't say thousands earlier, but so 45,000 in net income that we begin with at the end of the accounting period, December 31st, 2021. And here we're making adjustments due to non-cash effects. So we have to adjust net income. Now, why are we doing this? We're trying to reconcile cash back to the income statement. Depreciation is a non-cash expense. So that has to be adjusted upward because of the fact that we don't write a check for depreciation ever, right? And then changes in operating assets and liabilities, increase in accounts receivable. So why would this be a decrease in cash? It's because of the fact that we have receivables that are rising, but we have to make that particular adjustment, right? Increase in prepaid insurance. These increases actually then result in a negative. Why? Because we're talking about the effect in cash, not the effect on the income statement. Okay. Increase in accrued liabilities. Well, liabilities means that we've received the value of something, but we haven't paid it yet. And the same goes with payables. And so if you take 45,000, we've cut out the zeros here, plus 8 minus 12 minus 4 plus 7 plus 5, we end up with net cash flows, the same dollar figure, 49,000, that we ended up with where? In the direct statement here. But what was different? What was different is we simply took this particular methodology as a way of sort of getting to it, okay? And if you go back here to the operating activities, we're talking about the idea that net cash flows are the difference between inflows and outflows, okay? So here we get the same dollar figure in both particular cases, okay? And we can compare one to the other, and we end up at the same dollar amount. And so it's a sort of an effort at saying, okay, we have different methods of getting there, and we can get there in different ways. And this is an illustration 415 is really your guidepost for the indirect method, okay? So kind of mark this one as well if you can, however you want to do it. And this is what we do. We simply take these adjustments, right? Increase in, and we add non-cash expenses because we didn't write a check for depreciation, right? We take non-cash revenues and gains and things that didn't involve cash because if they didn't involve cash, we can't include them, so they got to be taken out of net income. And then income and balance sheet adjustments. And by the way, notice we have income statement adjustments and balance sheet adjustments. On the balance sheet, we have an increase in operating assets, which is going to be a decrease because we've presumably paid for these assets at some point with cash. And it likewise goes the other direction. If it's a decrease in operating assets, we probably receive cash, whatever those assets are, inventory, whatever the case might be, receivables, whatever. And the same goes with liabilities. If there's an increase in operating liabilities, it means it's an increase in cash flow coming in, and we take out operating liabilities because we pay things off. It's going to be a decrease in cash. And so we end up with, on a net cash flow from operating activities, and we say it says cash basis here because this is really accounting for cash and cash only. And why are we doing this? What is the purpose of the cash flow statement? Because we extol the value of the balance sheet income statement, saying they're the two most important statements by far. But what's this cash flow statement and why is it important? It's important because it allows users to understand that the preparers of the statements have reconciled cash from the beginning of the period to the ending of the period and have accounted for where it came from. Now, remember, there are three categories in the cash flow statement. This is just operating activities, which I think probably is the most complex of all, because we have these different tests that we can use, direct and indirect. Most companies use the indirect method because it's frankly a little bit easier to do, particularly when you talk about very, very large organizations. I mean, do you really want to go line by line by line about what is direct expense and what is direct revenue, whatnot? It's kind of challenging, but nonetheless, you're going to get to the same place at the end of the day, because if it doesn't reconcile, then there's a real problem, and it means that we haven't done good accounting. But we're arguing here this is just one way of getting to it. I do prefer the indirect method, even though FASB sort of emphasizes its preference with the direct method. It's a bit challenging in order to establish. All right. So couple quick quiz questions here are: in the direct method, Bloodstone Motors reported revenue of $7.5 million for its year ended December 31st, 2021. accounts receivable at the end of the prior period, December 31st, 2020 and 2021, were 480 and 532,500. Now, immediately think about this, right? We have a change in accounts receivable from one period to the next. So we're looking at December 31st, 2021. At the prior year end, we had 480 in receivables and 532,500 at this particular year end. Using the direct method of reporting cash flows from operating activities, Bledsoe would report collected cash reported from customers of. Well, all right, so we're using the direct method, meaning that we've only got one thing to record here. It's just a simple math problem, right? So we start with net income, right? And we simply do what? Well, we have an increase in accounts receivable. And remember, let's go back here to what we are talking about. We have to add the 480,000, which is the, 480,000 plus 7 minus 532, which gives us 7,447,000. Now, where did they come from, right? We had revenue of 7,500,000, right? And we're talking, and so we probably received most of it during the year. Obviously, the numbers sort of bear that out. We also collected some that was on hand at the beginning of the period. So this 480 has to be added to that. But then we did not collect the 532,500 because why? If we collected it, it wouldn't be able to account receivable at the end of the year. So remember, we started the year with 480,000 receivables. We had revenue, which we are assuming most of it was collected, but not all. What was not collected was 532,500. So the answer is 7 million, and I would have probably put 7,500,000 over here, plus 480, which is the amount we collected from, and we're assuming no bad debt here or whatever. This is a pretty simple model. And we're taking out the 532,500. So we end up with cash collected of 7,447,500, right? And that's all that's really going on here is this idea of sort of tracing cash in, cash out. In this case, it's basically cash in. We're recording here using the direct method, okay? The indirect method basically gets into this idea of using these adjustments based upon financial statements, but we're not here being asked about that question, okay? All right, so any questions about this particular example here that we talked about? So all we're really trying to do is reconcile the cash received. And remember, at some point, revenue doesn't really make a lot of sense unless it's collected somehow, usually in the form of cash, frankly. I know that we talk a good game in accounting about the idea that, well, maybe we'll swap something, a computer for this or whatever. And that's, I guess that happens occasionally, but it's not really, sort of cash is king. And so we sell things to customers for cash, typically. And they can take other forms like assuming a liability, whatnot, but it's usually cash. And that's really the main focus here is the cash flow statement, okay? All right, let's take another example here and talk about what's happening with operating cash flow. So we have Crinkle Pastries reported net income of 432,000 for its year ended December 31st, 2021. Purchases totaled 304,000. Accounts payable balances at the beginning and end of the year were 72,000 and 66,000. So remember, this is obviously going to be a change in cash of 6,000, right? Beginning and ending inventory balances were 88,000, 92,000. Assuming that all relevant information is presented, Crinkle Pastry would report operating cash flows of what? Okay, well, this is a little bit tricky, but let's just kind of take it one step at a time. We're going to take net income to begin with, right? Okay, we're going to take net income, which is 432,000, and we're going to take out the decrease in inventory, okay? And we're going to take out the decrease in inventory because of the fact that it's a reduction in the cash figure here, right? Okay, so decrease in inventory, and then we're going to decrease the decrease in accounts payable, which is also going to be 6,000. So as a result, the cash flows from operating activities is going to be 422,000. Remember, these differences, these asset accounts, reflect the action that's going on with cash on the income statement itself, okay? So as a result of this, we have to make these kind of adjustments that get us to the change in cash flow, the ending cash flow from the operating activities for this particular year, right? We're trying to, again, zooming back out to the big picture, we're trying to get to back to the balance sheet, which is the beginning cash and ending cash and how do we get from one to the other? What happened in that 12-month period, or whatever the period is, in order to get to that, right? Okay. And then purchases and merchandises, is really not necessarily a particular issue here. But the accounts payable and ending inventory, those are critical aspects. You can kind of read that in your text if you like about more info on that. Okay. And then one final bit here, and we're almost, I think we're in a sort of in for the day, because I want to sort of leave some room to talk more on Thursday about the exam itself. But some of the differences here in the international standards versus GAAP, and they're not really big, I don't think. We put dividends received under operating activities in the international standards. They also put dividends received there, or there's the option of putting it here under investing activities. And my own personal opinion, I kind of like this element better. I find myself, sort of drawn more to the international standards. And I know this may not make me the most popular person around the water cooler, but I do think the international standards, because they've sort of reset, they have a chance to look at things anew, and they're not really burdened by some of the traditions that we have under GAAP accounting. They can sort of set their own rules. And by the way, multinational companies will report under IFRS and GAAP either way, but you can do it either way. So not a huge difference here in terms of the treatment, in terms of operating, investing, and financing activities. And where we are sort of ending up here is the idea of going on to the other elements of the cash flow statement itself, including this idea of going to invest in financing, which we're going to get to, and that's going to be the last topic we talk about. But the example they give in your text was of Siemens. It's a big, I think it's a chemical company. And what do we got going on? We have statement of cash flows, and we have cash flows from financing activities, which we haven't really gotten to yet, and we're going to get to. And there's an element there that is a little bit different, and we have interest there under financing activities itself. So, all right, real quickly, and I think we're going to be sort of wrapping it up here, is which of the following is accurate concerning presentations of statements and recording in IFRS compliance? Unlike US GAAP, IFRS requires certain minimum information to be disclosed on the financing income statement. Now, this kind of goes back a ways. We're sort of, this is not even something that we really talked about today. And IFRS does require certain minimum information. US GAAP and IFRS display interest and dividends differently on the statement of cash flows. Both US GAAP and IFRS allows companies to report comprehensive income as a single statement or in separate statements, whatever the case might be. And the answer is all of the above. All of the above are correct. So, and then when we come back on Thursday, we've only got a little bit more to go. We'll talk a bit more about the idea of profitability ratios, and but the idea of the operating activities is really sort of the big issue here with regard to the cash flow statement. When it comes to the other elements of the statement of cash flows, what we're really talking about is things like investing activities, which is more things like we're buying inventory or buying equipment and whatnot. We talk about the financing activities. We're talking about how we're funding these activities. Are we borrowing money? Are we raising cash? Whatever the case might be. And so those are elements that are going to come up as we get going a little bit later here. Okay. And so we get to some idea of ratios here a little bit. We'll talk a bit more about that. And we're also going to get to this idea of leverage and what leverage really means. And what does leverage mean? Now, it looks like we sort of skipped over the idea of investing and financing activities, but it's really analogous to what we talked about earlier with regard to operating activities. We're simply tracing the difference between money in and money out. So operating activities is really sort of the big one that we're talking about here. And we talked about the direct and indirect method. But we also get into things like investing and financing activities. And when we talk about what's going on here, we're really talking about what is happening with the balance sheet. On the investing side, it's are we expending cash to buy assets, and are we selling assets, right? And generating cash in its own right? When it comes to financing activities, it's how do we pay for it? Are we issuing stock? Are we paying back? Are we borrowing money? Are we paying back money? Are we paying interest on money? All these things are really relevant to that particular thing. So the investing and financing activities or areas that your text probably doesn't get into as much as what we would prefer. And I'm more than glad to go over some of these, but they have the same logic really as to what's going on with the operating activities, only a little bit simpler. All the idea is this idea of where does the money come from and where it goes. And we're going to try and get to reconciliation of beginning and ending cash based upon what has happened during the accounting period. Okay. So we come back on Thursday. We're wrapping this up a little bit early because I want to sort of leave a little bit of room here in order to talk about where we are. We're going to come to, we're going to start with some profitability analysis and talk a little bit more about ratios. And this will probably be the last that we get into this. Again, as I mentioned earlier, that in 2120, which is Principles 2, we carried this over from Principles 1 as content from Chapter 10, dealing with things like certain ratios. What we have not talked yet about are things like activity ratios, a lot of them having to do with operating activities, asset turnover, receivables turnover. We're going to get to those, talk about why those are important and why users care about these things and why they care about the trends in these things and what is really going on there. Okay. All right. So any questions about anything with regard to what we've talked about today? All right. Well, I will I'll post this video in YouTube, hopefully later today. And if you have questions, feel free to get with me. Otherwise, I will see you on Thursday.